The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Geoca, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Geoca.
Max Out Savings Show. I'm Ted Geoca, and we're talking savings, investments, and your retirement. Our show is all about building up wealth, understanding the world today, and dealing with very complex issues. Our motto and our philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. We're going to try to help you today on the show come up with some of these ideas. We got a lot to talk about in the show today. A lot of moving parts. It's a lot of things are happening out there in the world and bringing to you and affecting your retirement in many big ways. And we're going to be hitting on those today and trying to help you understand what's really going on out there. First, we always like to start. Are you saving enough money? Are you building up wealth? How are you going to be set for retirement? And the answer is typically to that is, well, how much are you putting away in your company savings plan? Or it could be with the state, it could be with the a nonprofit, but how much are you putting away? It should be 10% minimum plus the average match, which is 3 or 4%. That gets you about 13.5%. That's what the numbers say you need for retirement. Now, if you're in your 50s, now's the time to really start hitting. If you're behind, you got plenty of time. You got 10, 15 years more to put away money. You're at your peak earnings. Now's the time to really sock it away if you're behind schedule. So maybe increase it to 15%. The Chinese and the Japanese, they save about 25 or 30% of their savings. So this isn't a big ask, but if you put that money away, you're going to be set for retirement. Look, we live in a country with $40 trillion worth of debt. A little under that. You're going to be hearing some headlines in a month or two about that, but close to $40 trillion with massive entitlement programs. The question is, how are they going to support all this stuff? And the answer is it's going to be pretty tough. So you better protect yourself. I mean, the one reason the Chinese in particular save a lot of money, they don't trust the government very much to support them. There's not safety nets all over the place. Well, what happens if those safety nets start fraying in the United States? So take charge of your retirement, start putting away that money, save aggressively, invest conservatively, make a difference in your life. These are the best money-making, wealth-building programs I've ever seen are these plans, because the money just gets put away and you don't see it, so you're not spending it. Now, wow, what a week in the market. It just was just all over the place this week, and looking at it, some really big developments are happening. Actually, now I say that, what a week. The market was down, was up 1% on the week. Okay, which is truly extraordinary, given the fact that you had a major, probably the hottest hedge fund out there, blow up. And so looking at the weekly, it looks like nothing to see here. But if you look at a daily, you see some really big swings culminating with a big decline on Wednesday. What happened there? The markets plunged all of a sudden about 1 o'clock in the afternoon, just started collapsing. Well, what happened was there was a hedge fund that was in financial trouble, and this is a big story here. I think it's much bigger than people think. It's kind of being swept under the rug. Nothing to see here. Move along. But I think it's a big deal. It's opening up a can of worms in my mind that really is bringing me back to 2007. And I don't like that. I don't like to see that. We were around in 2007, and this show, as long-time listeners know, that's why we have so many listeners. We pointed out at the time that the investment late November that we felt there was going to be failures of major investment banks on Wall Street. So that's not, and we laid out the case. We don't just say something's going to happen, the market's going to crash. We tell you why we think this is going to happen, and the trick is the time frame, of course. This was not a good situation. There's a hedge fund called Situational Awareness. I had to keep looking at the name. It's kind of, most of these are pretty simple to remember, but for some reason, this one, like, what is this? Situational Awareness. It was run by an AI expert, 24 years old, that was the expert on AI, and his name was Leopold Archenbrenner. And Leopold set up a hedge fund, and he had massive returns. He was up like 400%. There was big hedge funds that were putting money with Leopold so they could see what Leopold was doing, so they could shadow him. And so he was the hottest guy on Wall Street, and he blew up on Thursday. Wiped out. He liquidated. He had margin calls coming in, and he liquidated all his public companies. Now he owns parts of OpenAI, Anthropic, and other companies. This guy was so well known and prominent that he got into a lot of the real hot deals privately. So he kept those. He had $45 billion assets at the beginning of July. It's down to about 10 billion now, and that's only because he had private equity holdings that could not be sold off. Just once, this Ted. Hello. Sorry about that. The reason I answered the phone was we're now on YouTube now, and I want to make sure that there wasn't a problem with the system. So with the Max Out Savings Show is now on YouTube. There's a lot of demand for it. You can get it at the radio station AM 1070. Go to the YouTube section. We're there. We're also going to be having it on the TED at Max Out Savings. Look up Max Out Savings, Ted Geoca. You should be able to find it. We're still getting them on my side, but a lot of exciting stuff happening. So, but back to this. Back to situational awareness. So this guy was the hottest guy on Wall Street. Everybody followed him. He was a young prodigy. He went to Columbia at 15 years old and was the valedictorian of his class, which is truly extraordinary. And but his hedge fund blew up. Citadel, the big hedge fund Citadel took over the whole book. So as they say, they said, look, we'll take all your stocks, we'll give you X and get you out of them. So all he has left now is his private companies, which they're up some on those. This guy's made a lot of money, but this is a disaster. The problem is the smartest guy in the world, Leopold, didn't understand risk management. This is why we talk so much about risk management here on the Max Out Savings. This is what we're very good is trying to manage risk, understanding hidden risk. That's the key. Look, everyone can tell you the obvious risk. The key is understanding where the hidden risk, and that's what we try to bring to you on this show, and that's what we bring to our clients at Max Out Savings Advisors. Because we manage their retirement income. They worked all their life for it, and they need to have someone protecting them that knows what they're talking about. But back to situational awareness. So it's like, well, how did this happen? This guy's the smartest person in the world. So then you dig in a little further, and Leopold turned out he was, and this is really important right here. Turns out he was his leverage was 3 to 4 times. Some people are saying 5 times leverage. You're like, wait a minute, Ted, when I go buy $100,000 worth of stock and I use margin, I only have to pay $50,000. I can't put down $20,000 or $25,000 and get away with this. How does this happen? Well, it happens through derivatives. It happens through things. So here's the magical sentence in the whole thing. In recent months, this is where is this out of? I think that this is Bloomberg. In recent months, banks including Goldman Sachs Group, JP Morgan Chase, and Bank America were happy to power his rise, with some firms offering to lend situational awareness. I just put that situational awareness in there. Offer to lend the fund 4 to 5 times its capital. So the hedge fund was massively overvalued. And so this is what happens when excess leverage happens in the system. Now, we just saw this last week in Korea. where the Korean stock market fell 44% in basically about a month or so. And then, now look, it had a rally. It went up 18% on Friday. This is after the Korean government met in special session, and no telling what was said and what was done and what was committed to stabilize the market. But this shows you the dangers of excessive leverage. So here's the problem. JP Morgan, Goldman Sachs, Bank America. Now, pushing 4 to 5 time leverage on this hedge fund. Now, the question is, it's very simple. Was this the only hedge fund out there? Well, this guy is so smart. Clearly, he can do 4 or 5 times leverage. Or the question is this something JP Morgan, Goldman Sachs, and Bank America were doing to all the hedge funds? And the question comes in is, how much leverage is on Wall Street? And it sounds like there's a heck of a lot more leverage. Now, when they went to buy the buyout, okay, so it's really fascinating. Typically I hear whispers, "Hey, Ted," and you sort of hear this a little. This thing was like a ghost. It appeared out of nowhere after the market closed Wednesday afternoon. There wasn't a whisper anywhere out there. Yeah, I mean, I'm sure there was some places, but so this thing just blew up out of nowhere. That's not a good situation. This wasn't like a problem child private equity company that's recklessly making loans. These are the smartest people. They're in really good stuff. They use massive amounts of leverage. So the question is, who else has the leverage? So Citadel bought these reserves. And this is very complicated stuff. I'm trying to make it simple here, but you have to understand it because it affects your retirement. Is situational awareness was in trouble. The company, they're saying, look, we need more equity. They were trying to sell their private equity. They couldn't get out in time. They're like, we're going to have to blow you out, and it was going to crash the stock market, period, in my opinion, which I tend to know what I'm talking about. And so Citadel came up with an offer, because remember, if you're sitting on a whole bunch of other assets elsewhere, maybe you buy these assets just to get them off the market and stabilize the market to help yourself out. So Citadel came in, Millennium Asset Management, and a company called Jane Street, which we've talked about in this show a number of times. And so I look up the latest stuff on Jane Street. I'm like, well, how much assets does Jane Street have? And the answer is, according to Grok, but the latest filing, $777 billion worth of assets. They don't say if it's stocks or bonds. It could be some bonds, mostly ETFs. Now, understand, as we've talked about in the show, Jane Street got in trouble in India last year, I believe it was, for manipulating ETF prices. And so the question, are they manipulating ETF prices to their advantage here? So, well, that's irrelevant to this conversation. But so I look up, so I said, okay, fine. That's a lot of stocks and bonds they own. Well, how much is their capital base? Because if they got $777 billion worth of capital, hey, fine, it's their money. They can do with it what they want. However, they have supposedly about 50. First thing they said is they don't take outside capital typically. They have $55 billion. Of course, the Fed might come in now, but that's another story. They have $55 billion worth of capital. You go, well, Ted, that's a lot of money. Yeah, it's a lot of money until you look at the $777 billion. So the question is, who is lending these assets? And this is to what we're up here against a break. We'll be right back to talk about this. Again, this is a fascinating story. It's kind of swept under the rug. Nothing to see here, but those are the ones you want to watch out for when they're not. Typically they're screaming all over Wall Street about this, and it's like the biggest hoorah in the world. This time, it's kind of, it happened after market close, nothing to see here. And finally, David Faber, the next morning on CNBC mumbles something about, well, I tried to, this has happened, but I tried to call their compliance person, and he's, quote, no longer working there. So that was a dead end. So again, and there's some stories in the journal how they got into this trouble, but this is a big story. I want you to understand. We'll be right back after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Ted Geoca, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Geoca can come in, and he can help. Go to maxoutsavings.com and schedule some time with Ted. That's maxoutsavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 1033. The Answer.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Geoca of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
We return now to the Max Out Savings Show. Here's Ted Geoca.
Welcome back to the Max Out Savings Show. I'm Ted Geoca. We're talking savings, investments in your retirement on the show. We're talking about the leverage on Wall Street and the basically the blow up of situational awareness hedge fund, which was probably the hottest hedge fund out there, led by a brilliant young man, Leopold Archenbrenner. He's a genius at AI. I mean, just multi-factor genius, but he didn't understand risk controls, and something we talk about a lot in this show. But the problem is the 4 to 5 times leverage. And the question is, where else is there leverage? Jane Street, we find out, has huge amounts of leverage in the ETF market. That they're specialized traders in that, picking off. What I'm suspecting is they're moving around the stocks inside. They own tons of ETFs and they trade them, and I'm suspecting they're adjusting the prices of the ETFs by buying individual stocks. I don't know what the deal is there, but anyway, but the problem is massive leverage. So who is lending these people 4 or 5 times leverage? A bunch of guys running and gunning on Wall Street. And it almost reminds me of these clowns in the mortgage market in 2007. Well, a little story. And look, we talked about the banking system. We're doing a lot of deep dives into the banking system, financial system. That's one of our areas we kind of specialize in, to really understand things. Understand we got a new Fed governor coming up. We want to understand it. I think Wall Street has misunderstood what Warsh is doing right now, and the central banks didn't have a big thing on that. And the question is there a Fed put under the market that comes and bails it out every time? We're trying to figure that out. Where's the money going to go? Well, we said a couple weeks ago, maybe a month or two back, we said we saw the balance sheets of the big banks, and we said, I was shocked on the size of the loans on the banks on their asset side, and it was like J.P. Morgan less than 10%, Citibank less than 10%. although they have 40% in other at JP Morgan, Citi. I'm not sure what that is. That might be government securities or something. Bank America, 23% loans. Wells Fargo came in at 53%. And so why is this a concern? I mean, this is really, you're not hearing this from anyone. This is really deep in the weeds, but you have to understand it if you want to understand the financial system and you want to protect your retirement. And the answer is, it's kind of like, wait a minute, these are banks. And so JP Morgan and them will tell you, well, look, we're lending, we got securities lending, we're lending to hedge funds, we're lending all these people. They're super liquid. That's correct. They're super liquid until they're not. And by at least lending to individuals and little companies all over the place, Bob and Bill might go under, but the rest of them don't. And so, yeah, you're hit on a few loans, but the whole, all of a sudden you don't have everybody not paying at the same time. So your risk is spread over an enormously bigger, more robust industrial base of the United States of America, not piled up on top of Wall Street, where you've got, what's his name here? Leopold at the top of the apex pyramid, a 24-year-old trader in the AI investments. And if you look at, it's an interesting story. And I think I covered this at the time. I don't remember if I mentioned this, but because I pointed out, I was shocked at those balance sheets of these big banks. And here's one from, with JP Morgan, and this was as of April. Let me see. It shows since the end of 24, JP Morgan's balance sheet is up $900 billion. And it was, all this growth came from repos, trading, and buying treasury debt. Lending was only $150 billion of the $900 billion. And most of this stuff went to fund private credit, not industry. So these big banks are funding Wall Street. They're funding this bull market. They're funding this AI build out. And now they're way out they're way out on the deal. And hold on just 1 second here. Okay, good. So they're doing the build out, and again, guys, we're doing the new YouTube, which is, we've got a little learning curve here. So they're not funding out a build out of industry, the big Wall Street. They're funding this run up in stock prices. Okay, well, this is a big problem because we just had one of them blow up, and then we find out he has 3, 4, or 5 times leverage. And like, wait, where did that come from? Who are the fools lending that money to this guy right here who's 24 years old? And actually, hey, he might be bright at 24, but why is he getting this type of leverage that the common person isn't getting at all? And what's going on here? And I think this raises some really big concerns. It raises concerns about the banking system. I can tell you, people have said, Ted, what about, I've been saying the banks are solid, in good shape across the board. I'm retracting that. I think there's look, we got to find out what's inside of these big Wall Street banks. Okay, are these balance sheets piled up into assets on Wall Street that could fall apart or cross lending, which one company gets in trouble, it cascades the whole system. Now that's kind of a little hyperbolic there. But it is a fair statement, is why is all these assets of our banking system piled up on Wall Street trading firms? And this is a really big story. And it not a word out of it anywhere at all on this subject, which that tells you it's a potential problem. And so So the question is, by the way, looking at Wells Fargo has 53% in loans. Why is that? A couple things. Wells Fargo's more of a West Coast bank. It used to be, but they're also very conservative. They got in trouble with the governments. They were lending how much they could, quote, lever their balance sheet. So Wells Fargo's over there lending away to corporate America, to individuals, and doing their banking business, while the Fed in the banking system and the Treasury has allowed these other banks to go wild, leveraging their balance sheet on Wall Street. And so if it was my money and big money like Ted, where would you? I want to be in a safe bank. I would go with Wells Fargo. I mean, I think you look at that. These guys, it has a better risk profile than the rest of these banks, and I think this is a real concern. And I think this is something we're going to have to watch out for. I mean, again, shocking amount of lending going on Wall Street. Look at the balance sheets of the, JP Morgan, 10, maybe 15% to be generous somehow. That's it. The thing is basically lending out is basically funding the biggest bull market in history of the world. Well, how does that end well for JP Morgan when the market eventually has a bear market, which has happened time and again for like 5,000 years? And so I think this is a concern. I don't think this is over with yet. I think it's really fascinating. If you look at the S&P 500, it's probably it's off from. Bear with me just a second. This is live here because I just want to pull this up. Yeah, it's off 2 or 3% from the all-time high. Well, if you just had a blow up of a major hedge fund on Wall Street, and the market's only down 3% from the high in the S&P, that's clearly saying that there's not a lot of concern out there. I think I would feel better if the market was down 10 or 15%, and they were able to push up a bunch of stocks today on Friday to try to stabilize the market, and it basically came from the really big stocks that the big mega caps like Amazon and stuff. They kind of jacked up to control the market, and so this market, I think you have to be somewhat careful with this market right now. And we write about this in our Max Out Savings report. We talk about the demand for money. Is there enough money? And we just sent this out. I mean, again, you're not hearing this anywhere else out there. The question is there enough money? It's not. We said it's not just Google spending huge money in AI. Microsoft, Meta, Amazon, Nvidia, SpaceX, and Oracle for 2026. The AI build out is likely to be over $800 billion. There more next year. It's going to be over 1.1 billion next year. Major AI companies have 1 trillion off the balance sheet obligations as well. And then we point out that we're running a $2 trillion budget deficit in the United States. We're going to need an additional $400 billion to rebuild our military due to all these wars around the world, and we're short on munitions. If you look at the Middle East has had a lot of destruction of oil infrastructure and bases and other things. They're looking to borrow money. Americans need to borrow more money now. It's across the board. AI, the private equity is in trouble, so they're having to look for other sources. And all of a sudden, where's that money likely going to come from? We got these Wall Street, the banks are lending enormous amounts of money to Wall Street. By the way, this is why JP Morgan made that big statement about we're going to live $1.5 trillion to build up manufacturing in the United States. The reason they're doing that is Jamie Dimon looked at his balance sheet and he realized the whole thing was levered to Wall Street, and he's scrambling to get out of it and diversify his loan book. And so the question is that money is likely going to be pulled back from Wall Street. Keep in mind, one thing to keep in mind here is, look, the question is, was situational awareness hedge fund that blew up the only one with high leverage? The answer is probably no. You don't think that JP Morgan, Goldman Sachs, and who else? Bank of America, and quite frankly, Morgan Stanley too, they're in it too, aren't picking their client phone and calling their hedge fund clients and how's your leverage? What's your situation? What are you doing to reduce leverage? How can we, to try to stabilize the situation out there? But this is not a good situation because we're talking about a leverage problem. Now, can the market go up next week or a couple of weeks? Sure. But a couple other things that are happening as well. We have higher interest rates coming up. And so, if you look at the 2-year, it's at 4.30 right now, 4.3%, which is quite frankly after what I just said looks pretty good. And by the way, I'm talking about the treasuries. most of these bank assets, the Treasury and the Fed wants the banks in the Treasury market, in the Treasury bill market. The problem is a lot of the assets are securities, they're repos, reverse repos, lending to other companies, all types of complicated stuff. So it's not as stable as people think versus stable Treasuries. The 10 years at 475, in the 30-year bond right now is at 5.27%. This is a 19-year high. It's breaking out. The 10-year looks like it's breaking out to new highs too. Look, it's not a good situation in the Treasury market. If you look at it, okay, for the week this week, as we talked about, situational awareness blew up. It was a massive. The $45 billion fund collapsed to $10 billion. They had to have an emergency bailout by Citadel that took over all the public assets. Every other time I remember that, the thing that starts going up the most are treasuries. People are like, look, I'm done with this. Get me into government securities. Well, the 30-year bond was up. It went from 5.1 to 5.275 to a new high this week on that news. So think about that. Again, that shouldn't have happened. That's a warning sign. Higher interest rates are not a positive for Wall Street. And so we've got hedge funds in trouble. We have rising interest rates. Now there's some concern that Kevin Warsh is going to be more lenient on inflation. I still think they're going to push down the short end of the bond curve and be a little more flexible on the long end, which means rates are going to go up on the longer bonds and rates on the shorter bonds go down. And by the way, when it comes to bonds, keep in mind, I was surprised. I was talking about a very sophisticated friend of mine, very wealthy, and he goes, yeah, rates are up, and so bond yields are up this week. I'm like, no, rates are up, bond prices go down. So when interest rates go up, bond prices go down. So they move inversely. So when you hear interest rates are going up, that means bond prices are going down. It's a lot of people kind of struggle with that thing, but just think of a teeter-totter. Interest rates go up, bond prices go down. And so we have interest rates going up. Well, let's see what's happening with the dollar here today. How did that do this week? Okay, the dollar fell this week. It fell 1.6%. And so again, the dollar is going down. Normally the dollar should be going up. So there seems to be some type of not crisis, but there's some type of concern in the Treasury market that's overriding a failure of a major investment firm. That's telling you that there's other problems out there. And now the dollar, so I'm going to cover that. The dollar might not be as negative because there's some things going on in Japan. We're going to cover that. But what I want you to understand is there's massive demand for money in the world today, enormous, unlike anything we've ever seen. We've not been through a bill, and I didn't even mention the $1 trillion worth of factories that everybody from Eli Lilly to Ford Motor and Toyota are bringing factories back to the United States. That also costs money. Trump claims it's $1 trillion. Our numbers are closer to 500 billion. But again, where does that money come from? So there's massive demand for money. The money has to come from somewhere. At the same time, there's been an enormous amount of money parked on Wall Street with speculators in hedge funds that are now sort of in trouble, and the money's likely to come out of it. That's not a positive for the market. We're going to talk some more about this after this quick break right here on the Max Out Savings Show and how it will affect your retirement. Again, look, typically these conversations are held with the biggest hedge funds in the world. You're getting it, because it's going to affect your retirement, and I want you to understand that. We'll be right back after this quick break on the Max Out Savings Show.
The Max Out Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Ted Geoca, and I approve this message.
Max Out Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or maxoutsavings.com. Remember, you can hear the Max Out Savings program right here Saturdays at 10 a.m. on AM 1070 and FM 1033. The Answer.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
This is Ted Geoca, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
We return now to the Max Out Savings Show. Here's Ted Geoca.
Welcome back to the Max Out Savings Show. We're talking savings investments in your retirement. I want to mention one of our sponsors, Advanced Longevity, here in Houston, Texas, in Bel Air. These guys, they have all types of programs to kind of understand your health, improve your health, and understand where you're going. They have a full body scan, which they've got a great deal for our listeners, that they will sit there and take, using a scanners, they will take a picture of your body, and then they can tell whether you have heart issues, kidney issues, all types of issues, cancer, everything, by looking at these scans. They're remarkable. They take like 640 slices of your body. It's like watching a sci-fi movie and something out of Star Trek, and they can go through and show you all the potential problems, or if you're healthy too. Some people are just convinced that they have 15 different ailments, and they really don't. Those are helpful too. But it's a remarkable process. This is pay only. It's not insurance, but it lets you get a great snapshot of your health as it is right now. And it also really highlights maybe some problems, but when you see them live in action, you're like, whoa, that's interesting. And so it's something to take a look at. It's Advanced Longevity in Bel Air, Texas. Give them a call and mention the Max Out Savings Show, and they have some special pricing for us. Couple other things here I wanted to just touch base on. Exxon and Chevron, some of the oil companies reported they were good. Exxon was a little under. If I had to guess, I don't think Exxon was just real keen on beating their numbers. Oil prices are high. President Trump is all over them. And so I don't think they were looking to just hit the lights out with numbers. So I've been running Exxon. I would have been sandbagging earnings all over the place, so it doesn't look like you're making too much money, figuring the president's watching. Interesting thing they did, though. Exxon, Chevron, and Shell all cut debt rather than buying back large amounts of stock. They really cut back a lot of debt. Exxon reduced their debt by more than $7 billion in the quarter, equivalent to half the company's cash flow, net income. Chevron reduced it $8.4 billion as well, slashing the net debt to cash flow in half. Shell cut their debt by $10.8 billion as well. So they're not aggressively spending it all over the place. They're kind of paring back their stock buybacks a little bit. Again, the president doesn't want to see companies buying back stock. passing out big raises and all types of things. He wants to see them, producing oil and gas at a reasonable price and not price gouging the consumers. So I think these numbers could have been better if they really pushed it. I don't think there was really a political advantage to doing it. That's our read. Look, we're still dealing with. We talk about this in the Max Out Savings Report. Very tight oil and gas pricing out there. If you look at a lot of the Russian refineries have been attacked. 40% of them have been attacked pretty hard, over 40%. That's cutting back the production of diesel fuel, jet fuel, and gasoline. The refineries in the Persian Gulf are shut down in many cases. It's tight refining margins. The refining margins are probably $20 above where they normally are. So when you hear Brent crude's at $90, the true number for oil, that if you're really pricing it to gasoline, is probably 120 if you're using that as a benchmark, because they're not seeing it. They're trying to hold. There's not as much demand for oil because they don't have the refining capacity, but that means there's shortages of the products. And so this is a serious situation. A lot of our reserves are down. We pulled our reserves down, and this war is really crimping things. And Iran, I think, knows it is the problem. These people are smart people, and so this is causing problems out there. Again, higher oil prices, higher interest rates breaking out to the upside, more inflation, a demand for money from all these, from AI, from new plant and equipment, from a $2 trillion deficit, from $400 billion additional defense spending, from Arab countries needing monies to rebuild. This is all causing problems, and this money is going to start coming out of Wall Street. And as we talked about at the beginning of the show, accompanying for y'all that came in late, situational awareness, run by Leopold Arschenbrenner, was probably the hottest hedge fund out there. This guy was so hot and powerful that other big hedge funds put money with him so they could see what he was doing, and they were sort of shadowing him. The fund blew up. They took on too much leverage and went from $45 billion to $10 billion. The only reason they have $10 billion is that's basically the private equity stuff that couldn't be sold off and wasn't leveraged, that was protected. And so that's kind of all they have left. They're still up because they've made so much money, but it's a disaster. Lots of investors have been hurt quite a bit badly by this, investing in AI companies. We've talked about the dangers of these big mega cap AI companies. There's not enough money to sell when people not enough buyers to be, because they're so large. When Apple has a $25 trillion market, $5 trillion market cap. And this is the problem. I mean, Apple, I think, fell 7% this week. Some of the other companies are up 15. We're seeing a lot of volatility in the stocks. That's not a good sign when you see that type of volatility. I think Amazon or Mike was up 13% one day this week. Microsoft was up 13%. Other stocks are down, up 10%, down 10%. These are warning signs of you got to be a little bit more careful out there. And so this is a big deal, this blow up. Typically a failure of a fund puts a bottom in. I think it puts a short-term bottom in, very short-term bottom. I still think there's issues with the leverage on Wall Street that people are only beginning to grapple with. We talked about a lot of the big banks, candidly, their balance sheets, JP Morgan, maybe 10 or 15% bonds, enormous lending to private equity companies, to Wall Street. The shocking thing that came out of situational awareness was, depending on who you talk to, their leverage was 3, 4 to 5 times. In Morgan Stanley, Goldman Sachs, Bank of America, and likely probably JP Morgan, Goldman Sachs, Bank of America, and likely Morgan Stanley were really pushing this, and other bankers. So rather than lending to corporate America, lending to manufacturing America, they were out there basically lending to Wall Street. This raises real red flags to the financial system, in my opinion. And so I think in this environment, I think you really have to continue to be cautious. I mean, there's people claiming a crash or the trick is understanding why things happen. This is why we were so good in 2007 and 2008, going into 2009. We did phenomenally well because we understand the financial system. We studied it for forever, and we dig into these things and find out what you're not hearing from anyone else, you're hearing from us. And this is in our free Max Out Savings report as well. So, but again, there's a lot of problems. Financial problems on Wall Street, hedge fund failures, excess leverage, rising interest rates, private equity. But the private equity hasn't gone away. We have the dollar's kind of falling. They're now trying to support the Japanese yen, so we need to watch that closely because that could cause real problems. That's one of the reasons why. Look. It's interesting that President Trump went to Camp David this week, it brought in his cabinet. The question is, they're talking about the war. They're likely also talking about the problems on Wall Street, the problems in Japan with the Japanese yen, and they've moved in for the first time this week. The U.S. is helping Japan support the yen. Again, these are raising red flags. And right now, there's a lot of red flags starting to crop up across the board here, and I didn't even mention the higher oil prices that we talked about. And the question is, that they have to be looking at is, are any of these Wall Street banks in trouble? We don't think so, but you don't know what. But the lending is the concern. And look, people have been asking me about the banks for years. I said, look, they've been much better with they have much higher capital ratios than they had in 07 and 08. They're in much better shape. But what has just exploded in about the last 12 months is enormous lending to Wall Street and Wall Street hedge funds. And that is a concern. And this is going to tighten credit. I think between the long-term, the situational awareness, which is almost similar to long-term capital, and other issues with private credit out there, and also the rising credit default spreads for AI companies like Nvidia and Oracle and others. They're spending such enormous money. This is gonna tighten credit. This is gonna make money more expensive. This is a really big deal that's happening. And when credit starts tightening, that's not the most positive thing for Wall Street. And so this is something we want to kind of continue to watch closely here. Again, I do think you have to be cautious. We had some hedges on. We pulled one of our hedges off at the end of the year, about midweek on the QQQ. We might put it back on. Again, we're just trying to. We've had a very good year, and we just want to make sure we kind of continue to manage through this slowly. I think we have Larry with the caller. What's the question? Just type me in the question. I'll get Larry's question answered if they can. But that's kind of what we're dealing with. So what really changed this week was a couple things. Was the situational awareness. And probably the problems in Japan are starting to come to a head a little. There's a real school of thought that the Japanese yen could get out of control and cause a real issue. And so the question from Larry was the price of gold. Look, I think gold is going to start moving higher. There's a lot of uncertainty out there all of a sudden. I think the Fed was really trying to come up with that. Look, the Fed's long-term plan is to try to make treasuries, U.S. treasuries, not gold, crypto, repos, all types of other fancy Wall Street security collateral. They want to make the treasuries, so they're going to try to push on that. But right now, that's being overwhelmed by the issues with long-term credit and the possible deleveraging on Wall Street. There's a real issue with possible deleveraging on Wall Street. I think we got to be real careful in here, and so we'll just have to kind of wait and see. What this simply means is you want to be sure of your investments. If you're not sure, you want to be in good stuff you want to own. You don't want to go liquidate everything. You want to put some hedges in place, and you want to be cautious, and you want to spread the risk out, because these things can move in different directions that aren't real clear. And we'll bring them to you here on the Max Out Savings Show. A couple things. If you need some help, we manage retirement money, trust, big money for people. They retire, they come to us. at Max Out Savings Advisors. We're value investors in the stock and bond market. If you need some help, you can just go to the website, drop me an email, or call up the phone number, 713-627-0400. Give us a call. I'll set up an appointment with you here in Houston, Texas. This is our headquarters, and show you how we manage money. At a minimum, go to the website, sign up for our free newsletter, the Max Out Savings Show. It's a Max Out Savings report. It's completely free. Yeah, just sign up for the report, and that's it. By the way, remember, we're on YouTube now, so you can get repeats of the webcast at Max Out by going Ted at Max Out Savings, and also go to the AM 1070, the radio station. They have them as well, so you can get repeats of this show as well to kind of understand it and see it. We're getting a lot of demand now. A lot of people are listening to the show, and so we're getting people from all over the country now starting to follow us. So those are the big developments here. You want to continue to, what do I like? I still like shorter term treasuries. Have been saying, now we could shift in here somewhere, but for now, shorter term treasuries. And the other thing one thing we do a lot, we put a lot of high quality corporate bonds in our portfolios too. Short term, again, we want bonds that if there's a big crisis, we don't want problems with our bonds. We want to make sure we're getting our money back. That's all once you sign up for a bond, you're getting 4 or 5%. That's all you're getting back. So you don't want to take risk. And so we're really trying to do a lot of risk analysis. Remember the lesson this week of basically situational awareness is you can be the brightest person in the world, but if you don't have good risk management, you get wiped out. And this is a perfect example. This week went from 45 million to 10 million. I hope everybody has a great weekend. And remember, if you get a chance, go to our website, maxoutsavings.com. But remember our motto and philosophy, which is the key to everything, which is to save aggressively and invest conservatively. That, my friends, is the key to building up wealth over the long term. Save aggressively, invest conservatively. That will always get you ahead in the future. And if you haven't done it yet, now's the time to take charge of your retirement. We'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Geoca, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Geoca on AM 1070. The Answer.